We're starting off with a story that's been making waves in the financial markets, the significant drop in South Korean stocks, particularly in the semiconductor sector. The KOSPI, South Korea's main stock index, has fallen by nearly 8%, with major players like SK Hynix and Samsung Electronics taking a hit. So, what's behind this decline? Well, it seems that fresh concerns over artificial intelligence spending have added to the pressure on semiconductor stocks. With companies pouring billions of dollars into AI, investors are questioning whether these investments will generate enough returns to justify the spending. This uncertainty has led to a sell-off in chip stocks, not just in South Korea but also in the US. Another factor contributing to this decline is the rise of Chinese technology companies. Chongqing Memory Technologies, for example, made a blockbuster market debut, soaring nearly 500%. This has raised concerns among investors that Chinese companies may be gaining ground on their Korean and American counterparts. Additionally, the U.S. Federal Reserve's upcoming interest rate decision is also weighing on investor minds. With expectations of a potential rate hike in September, markets are pricing in an 81% probability of an increase. This uncertainty is contributing to the volatility we are seeing in the markets. It's also worth noting that global cues are weak, with U.S. stock futures edging lower in early Asian trading. The Dow and S&P 500 had a mixed session on Wall Street, while the Nasdaq Composite slipped due to the sell-off in semiconductor stocks. As we navigate these complex market dynamics, it's essential to remain informed and adapt to changing circumstances. We'll be keeping a close eye on these developments and providing you with expert analysis and insights to help you make sense of it all. We'll be right back with more from the world of stocks and finance on the Riskwiser Zone. Welcome back to the Riskwiser Zone. We're diving into the world of personal finance and investments. Certificates of deposit, or CDs, have long been a popular option for those looking for low-risk investments with fixed returns. But with interest rates fluctuating over the years, it's essential to stay informed about the best options available. Recently, we've seen a shift in CD rates, with some institutions offering higher yields than others. Online banks, in particular, have been competitive in their offerings, often providing better rates than traditional brick-and-mortar banks due to lower overhead costs. However, it's crucial to ensure that any institution you consider is FDIC-insured or NCUA-insured for credit unions. To protect your deposits. When choosing a CD, it's not just about finding the highest APY. You need to consider your financial goals, the term length that works best for you, and understand the terms of the CD, including any potential withdrawal penalties. Inflation is also a factor to consider, especially for longer-term CDs, as they might not always keep pace with rising prices. Currently, some of the best CD rates are being offered for 1-year and 2-year terms, with APYs reaching up to 4.1%. These rates can provide a guaranteed return on your savings, making them an attractive option for those looking to grow their money without taking on too much risk. It's also worth noting that while CD rates have come down from their peak after the Fed's rate cuts, they remain high by historical standards. Experts have varying opinions on where CD rates are headed in 2026, but one thing is clear: staying informed and adapting your investment strategy accordingly is key to making the most of your savings. Whether you're a seasoned investor or just starting to build your savings, understanding the current landscape of CD rates can help you make more informed decisions about your financial future. Remember, it's always about finding the right balance between risk and return that aligns with your goals and timeline. Welcome back to the Riskwiser Zone. We're wrapping up today's show with a look at some key market movers. Two companies have been making headlines recently: Godfrey Phillips India, whose stock has been impacted by a significant tax demand, and Coforge, which reported strong Q1 results. Godfrey Phillips India's net profit declined due to a substantial tax outgo, but the company remains optimistic about its future prospects. On the other hand, Coforge saw a significant increase in revenue and profitability, driven by its AI-led engineering, data, and cloud services. The company's order book has strengthened, providing strong revenue visibility for the coming quarters. It's essential to consider multiple factors when evaluating these companies' performances. Godfrey Phillips India faces challenges related to taxation, while Coforge is benefiting from the growing demand for digital transformation and AI adoption. As investors, it's crucial to assess the risks and opportunities associated with each company and make informed decisions based on your individual financial goals and risk tolerance. In conclusion, both companies' stories serve as reminders that the market is constantly evolving, and it's vital to stay informed and adapt to changing circumstances. Whether you're a seasoned investor or just starting out, it's essential to approach the market with caution and carefully consider your investment decisions. That's all for today's Riskwiser Zone. Remember to like, share, and subscribe, and until next time, keep your finances in check.